Hello, my name is Jeff McTague and welcome. This is the 8th installment of my series on what I guarantee you is the best mutual fund selection process available in the market. Of course, I'm a bit biased because it's mine. Today I take a look at fund selection trait number 6, standard deviation, and its value in the fund selection process. While it is a bit more complicated, standard deviation basically says if a fund has a 12% average rate of return and a standard deviation of 4%, its return will range from 8 to 16% most of the time. Most of the time. In other words, on the way to a final performance, how calm or wild was the ride? Is there a cause and effect relationship between the volatility of a fund's returns and its relative performance? Does the measurement that is standard deviation have a value when selecting mutual funds? I've been conducting such research since 1997, and I think I've discovered a correlation between performance and standard deviation that serves a valuable function in the fund selection process. Between 1997 and 2016, I conducted 7 separate studies. For each study, the funds within each investment category were placed in quartiles based upon their standard deviation. The average return of each quartile of deviation was then computed. In years of very high returns, funds with a higher standard deviation produced the highest returns, and during years of negative returns, it was the funds with a low standard deviation that produced better returns. Let me show you what I discovered. Of the 7 studies, 4 covered periods of growth: 1996 to 1998, 2003 to 2005, 2012 and 2013, and 2014 to 2016. As the chart shows, during these periods of growth, funds with higher standard deviation outperform funds with lower standard deviation. I am sure this comes as no surprise to you, but what comes next just might. This chart you're looking at shows how often the low standard deviation funds outperform the high standard deviation funds in periods of negative returns. During these periods of market decline, the funds with a higher standard deviation got hammered far, far in excess of the funds that sported a lower standard deviation. And the return difference between the lowest standard deviation funds and the highest standard deviation funds in a bear market was a startling 11.96% per year. Compare that to the 1.35% advantage that the high standard deviation funds had in bull markets. These findings tell me that I want to own funds with low standard deviation in periods of market decline and funds with high standard deviation in periods of market growth. Well, that was brilliant, wasn't it? We obviously understand that probably without even doing any research. These findings tell me that I want to own funds with low standard deviation in periods of market decline and funds with high standard deviation in periods of market growth. But is this feasible? I suppose by using a momentum following formula, much like my 175-day moving average that you can find in fundalert.com, you could. It also might suggest you own your low standard deviation funds in buy and hold portfolios and market time portfolios of funds with higher standard deviation to minimize your losses. From my perspective, standard deviation can be best utilized with the age and risk tolerance of your clients. For clients with a low risk of portfolio loss, I would advocate for funds with a history of lower standard deviation. And of course, for clients with a desire for greater returns, understanding the commensurate higher risk, I would select from the pool of funds with higher standard deviation. Remember, The market giveth and the market taketh away. When I discover through my research that during periods of market growth, the high standard deviation funds outperform the low standard deviation funds by 1.35% per year, but during periods of market loss, the low standard deviation funds outperform those of high standard deviation by almost 12% a year. When I realized that bear markets, a 20% decline from market peaks, happen every 5.5 years, and that the average loss in those bear markets since 1900 is 32%, which requires a 47% gain back to break even. And oh, by the way, the most recent bear market, October 07 through March of 09, that drop stole 54% of market value, requiring an incredible 118% growth rate just back to break even with that October of 07 value. And we all would agree that the U.S. stock market is well past due for a market crash. Because of all this, I lean decidedly towards low standard deviation funds. Whether you agree with me or not, I trust you can see why standard deviation is indeed included as one of the 11 traits that lead to successful fund selection. Well, that's it for today. I trust you see the value of standard deviation in the fund selection process. I hope you will look back in on my next webcast when you will discover fund selection trait number 7, beta. Until then, this is Jeff McTague reminding you, unless you can prove it, it is just your opinion.
Right here, right now.